So we are now in the part 2 of our ST tax. In this part of ST tax, we will talk now about your exclusions and deductions. For exclusions, these are items of gross estate. However, the law wants you to remove it on your gross estate. Therefore, you should not include it because it is excluded. But in your deductions, these are items not inside the gross estate. However, the law wants you to reduce your gross estate by the provisions of the law. Exceptions on this are 4917 and your claims against insolvent persons. Because we said 4917 and claims against insolvent persons are items that must be first included, and then thereafter it will be considered as a deduction. So in SC tax, generally, first we need to know for our gross estate, we remove our ordinary deductions, our special deductions, and the share of surviving spouse. All of these items are deductions. After that, we get for your net estate. So we are still in your gross estate. We're done with inclusions and your valuation. We start first with your exclusions. Let's start now with your exclusions on your gross estate. So exclusions from gross estate. So these are properties, rights, or transfers that are specifically declared by the law as free from estate tax. Therefore, as a general rule, all items must be subject to estate tax if ever there will be a transmission of property from a decedent to an heir. However, under the law, certain items that must be included in your gross estate is excluded because of these provisions of the law. So they are not then considered in the determination of your gross estate. So they are not considered in your determination of gross estate. So when we say exclusions declared by the law, what law provides for your exclusions? These exclusions are found under the train law or the NIRC, and these exclusions under the special laws. So let's start first with exclusions under the train law. So exclusions under the train law, we have the following. First, Section 85, letter H, capital of surviving spouse. Next, Section 86, property outside the Philippines of a non-resident. Next, Section 104, exemptions under the reciprocity clause. Section 87, certain transmissions that is excluded for your SC tax. Section 97, withdrawals from bank. So we will discuss all of these exclusions under the train law. Let's start first with Section 85, letter H, the capital of surviving spouse. So in the capital of surviving spouse, you should not always deduct this one or exclude this one as an item of your gross estate. Because generally, for an estate tax, you need to determine first if the decedent is married or unmarried. If the decedent is unmarried, therefore, all of his or her properties should be included. But if the decedent is married, you need to determine what is the conjugal property and what is the exclusive property. So you need to determine if ever the decedent is married on what are the properties that is considered conjugal and what are the properties that are considered exclusive. Now, under persons and family relations in your civil code, under your civil code, we have this certain marriage settlements or marriage relations. So generally, what we have is your conjugal partnership of gains or CPG. Next, we have your absolute community of property or ACP. And then the last one is the complete separation of property or absolute separation of property. So these are the items under your that governs your marriage relations. Now, before you get married, certain individuals enter into marriage relations. So they can enter into any other relations that they want. But under the law, as a general rule, this marriage relation now is your absolute community of property. But again, there's nothing in the law that prohibits an individual to enter into marriage settlements. So generally, before you get married, you talk with your partner or your spouse on what particular marriage relation that will govern your marriage. But again, if there's no marriage relation or marriage settlement, and or your marriage settlement initially is void, what will govern is your absolute community of property. If you still remember, under your partnership, we can classify your partnership as either conjugal partnership or absolute community. So when can you say that it is a conjugal partnership? There is a conjugal partnership if ever the partnership starts only during the marriage or at the date of marriage and thereafter. So there is a conjugal partnership if ever partnership starts only at the day of marriage and thereafter. Therefore, anything that happens before the marriage will not be included in the partnership because under your conjugal partnership, the partnership will only start at the date of your marriage. While in your absolute community, since we say it is absolute community, all of your properties during and after, so during and after will be added. So that's the difference between conjugal partnership and absolute community. In your conjugal partnership or the communion of properties will only start at the date of marriage and thereafter. In your absolute community, your partnership will start even before your marriage. So all of your properties before your marriage will commune together. So it will be added into a common pool and even thereafter. So let's take a look into the rule of your capital of surviving spouse as to your conjugal and absolute community. So first, we need to determine if ever that property is acquired before marriage or acquired during marriage. So first, if the property is acquired before marriage. By the way, the rules here cannot be found under the tax code. The rules here are found in your civil code, particularly under your person's family and person's family relations law. So first, your property acquired before marriage. We said under conjugal partnership, only those properties at the date of marriage and thereafter should be included. Therefore, before marriage is excluded, while in your absolute community, before marriage is included. Therefore, if you have acquired properties before marriage, whether that is gratuitous or onerous, under conjugal partnership, we said that will not be included. So dito, exclusive siya. While in your absolute community, it is considered communal or it is considered conjugal. Okay? Conjugal or communal is just the same. So when we say exclusive, it is only the property of one spouse, while communal, it is the property of both spouse. Okay? So generally, when you prepare your estate tax, these are the items of your gross estate, for example. You need to label it as either communal or conjugal and exclusive. So let's say we have here your house and then we have here your lot. Let's say your house is communal, you place the amount here. If your lot is exclusive, you place it here. Okay? So when we say exclusive here, this is the exclusive property of the decedent. But if it is an exclusive property of the surviving spouse, you should not exclude it. That's why we have here, you should not include it. That's why we have here capital of surviving spouse. What we mean here is the exclusive property of the surviving spouse. Therefore, in learning these items, we must also learn the items we include here and what items are the exclusive property only of the surviving spouse. Clear? Okay. So first, property acquired before marriage. Whether gratuitous or onerous, for conjugal partnership, it is exclusive because we said properties before marriage will not be included to the properties of the spouses. While in your absolute community, the properties acquired before marriage, whether gratuitous or onerous, should be considered as conjugal. Next, were the spouse as a legitimate descendant from a previous marriage. In this particular item, this is what we call a bar of transmission of property from one marriage to another marriage. So this happens if in case we have here A and B married, then A died, B subsequently married C. Okay, so the story here is there's a first marriage, so A and B is married. A died, therefore, there is now a transfer. There is now a subsequent marriage of B and C. Now, if A and B has descendants, or what we call heir, the properties must first be provided to that heir. Therefore, any properties of the spouse B cannot be transferred to the property of the new marriage. So now A and B, we have a previous descendant, okay, A and B, whatever are the properties of B here cannot be brought into the marriage because those properties must be given first to your descendants. Therefore, under the law, if there is a legitimate descendant from a previous marriage, it is exclusive. It is exclusive. Except if, of course, there is now a remarriage, but there is no legitimate descendant. If there is no legitimate descendant, then we do not have any problem. Okay? If ever there's no legitimate descendant, then we do not have a problem. But if there is a legitimate descendant, do not include it. It is exclusive, whether conjugal partnership or whether it is absolute community. Sir, why are we still talking about conjugal partnership and absolute community? Wherein you said before that what is only present now as a general rule is your absolute community. Because guys, on your SE tax, generally, what we look here is the date of your marriage. So if the date of your marriage is prior, what date is that? 1988. Prior 1988 or 1998, I'm not sure as to the date. It's 1988, I'm not sure as to the date. 1988, if it's prior 1998, what follows is conjugal partnership. But after 1998, it is absolute community. It is August. I'm not sure if it's 1988 or 1998. Just look at it. It's either 1988 or 1998. Masyadong late yung 1998. 1988. I feel it's 1998. So August 1998, if ever there is a marriage from August 1988, it is ACP. But before that, it is conjugal partnership. So if you prepare a particular gross estate soon in your practice, you need to determine the date of marriage. If the date of marriage is before 1988, what you will apply is this. Okay? Siyempre, may mga mamamatay pa lang na kinasal before 1988 because that's just around 30 years from this date. Therefore, if they married before 1988, it is still conjugal partnership. But if they married after 1988, then it is absolute community. Okay? So that's why we still need to discuss this one. Next, property acquired during marriage. If that is a property acquired during marriage by gratuitous title, it is exclusive. It is exclusive. Why? Because this is considered a donation, is specifically for one spouse. Okay? Sir, why is it considered exclusive? When we talk about gratuitous title, what comes into your mind will of course be a donation. If that is a donation, generally a donor will only name one of the person among the spouses. So if you donate, for example, A will donate to B. If B is married to C, A will donate to B, but B is married to C. Therefore, the donation of A is to B only. It is not to B and C. That's why any property acquired during the marriage out of a gratuitous title is a exclusive property of either spouse, whether it is A or whether it is B or whether it is C. to A donated to B, it is only for B. Therefore, it is the exclusive property of B. But that is not the case. The exception to this rule, if ever it is named to the spouses. If the gratuitous title or the donation now is named towards the spouses, so for example, A donated property to both B and C, therefore it becomes a conjugal property. But as a rule, a gratuitous title acquired by one spouse is considered exclusive. Gratuitous title acquired by one spouse is exclusive, but if the gratuitous title is named to spouses, therefore it is named to both of the spouse, it is considered conjugal. Next, onerous title. Since this was already acquired during the marriage, and by onerous title, meaning by a consideration, the consideration is generally from your conjugal or communal properties. Okay? So the consideration you use to acquire that particular property by onerous title came from your conjugal or communal property. That's why it will be considered conjugal or communal. Next, in exchange of exclusive property, since you acquire a property now by onerous title, but with your own exclusive property, it is considered exclusive. These two items are acquisitions of property by onerous title. Clear? 1 and 2 here are items that are considered acquisition of property by onerous title. But here in your onerous title, we assume that the consideration came from your communal or conjugal property. Therefore, it is considered conjugal. On the second one, it is an exchange of exclusive property. That's why it is considered exclusive. Clear? So here is still the same. In exchange of conjugal or communal property, it is still conjugal. Next, fruits or income from exclusive property. This is a difference between your absolute community and your conjugal partnership. So here, in your conjugal partnership, we said any items after the marriage, it's considered community or conjugal property. Therefore, any gains should also be included as part of community. Okay? Kaya nga ang tawag dyan is conjugal partnership of gains or CPG. Because the gain, whether it comes from exclusive or community property, the gain, whether it comes from exclusive or community property, is considered a community or conjugal property. Because what communes here are your gains during your partnership. But in an absolute community, the fruits or income from exclusive property is considered exclusive. The fruits or income from exclusive property is considered exclusive as a rule under your law. And lastly, fruits or income from conjugal or community property are considered conjugal or communal. Clear? Okay. So let's discuss the rules again. So in your gross estate, you need to determine whether the decedent is unmarried or single, or the decedent is considered married. If the decedent is considered unmarried or single, all of the properties will be included. But if that is married, you need to determine conjugal properties and exclusive properties. Conjugal property should be included. Exclusive property, you need to determine, is that the exclusive property of the decedent or the exclusive property of the surviving spouse? If ever that is considered an exclusive property of the decedent, it is considered included. But if that is an exclusive property of surviving spouse, it is considered excluded. So, sir, what do we mean by the capital of surviving spouse here? As an exclusion, what we mean here is the exclusive property of the surviving spouse. So you already know all the rules. If ever you can classify a property of the spouse as exclusive, the surviving spouse, then you exclude it. But if that exclusive property is a property of the decedent, include. If that property is considered conjugal, include. Clear? Okay, we go back to our inclusions. Our inclusions as a general rule, if that is a resident or citizen, all properties. Okay. As an exception to this all properties in case of married, first exception is the capital of the surviving spouse. When we talk about capital of surviving spouse, please take note, it is only the exclusive property of the surviving spouse, nothing else. Clear? Capital of surviving spouse, the exclusive property of the surviving spouse only. Baka kasi, tanggalin nyo rin yung exclusive property ni decedent. Hindi. Kasi ang exclusion lang na sinasabi ng law natin ay yung capital of the surviving spouse. Tandaan, yan yung exclusive ni surviving spouse. So ang kailangan ninyong unahin dito is to determine the property. So once you determine the property, you determine whether that property is considered conjugal or absolute community. Conjugal partnership or absolute community. Once you determine that the marriage settlement type, you determine now whether that property is considered exclusive or communal based on these rules. Okay? So you follow first its rule. And then once you set it up, ito sa conjugal yan, ito exclusive ni decedent, ito exclusive ni surviving spouse, alam mo na yung sama mo sa gross estate at alam mo na yung tatanggalin mo. Ano lang yung tatanggalin? Yung exclusive ni surviving spouse. Okay? So these rules applies to both spouses. What you should determine then is whether it is conjugal, exclusive of the decedent, or exclusive of surviving spouse. Because if it's conjugal and exclusive of decedent, you include, but if exclusive of surviving spouse, you exclude. Okay? I hope we are clear under section 85H of your NIRC. Only the exclusive property of surviving spouse. Sir, ano din yung itsura niya sa aming gross estate? So what you will only include on your community or conjugal property and your exclusive property are the items of the decedent. So hahatiin niyo siya. So for example, house, community, ilagay mo dyan. Yung lot, exclusive niya lang, ilagay mo dyan. Okay? But do not include the exclusive property of the surviving spouse. The estate return nyo, hahatiin na siya whether it is community or exclusive. Pero sa una pa lang, kailangan na ninyong alamin kung ano yung exclusive ni surviving spouse kasi tatanggalin niya yan. Sana na-gets nyo to. Once you know the rules here, madali na lang yan. Next, exclusion, Section 86 and Section 104 of your train law. Section 86 is the property outside the Philippines of a non-resident alien. We all know this one. As a general rule, we said if you're resident or a citizen, world estate. If you are a non-resident alien, only your Philippine estate. Therefore, your foreign or outside the Philippines property is excluded. Okay, we have already discussed that. Next, Section 104, exempt under the reciprocity clause. I hope you still remember this reciprocity clause. So as a rule on your NRA, if ever the NRA has an intangible personal property. What is intangible personal property again? These are your financial assets and your intangible assets. Once your NRA has an intangible personal property, that intangible personal property is subject to reciprocity should be excluded. You also know that one already. Next, Section 87, ito yung apat. Merger of usufruct, we have your transmission, two transmissions, and then last one is your bequests and devices to your charitable institutions. So let's start first with your merger of usufruct in the owner of the naked title. Okay, so in this merger of usufruct in the owner of the naked title, what you need to determine here is there is a usufruct and there is a naked title. Okay, so there is a usufruct and there is a naked title. When we say usufruct, you have the right over the use and the fruits out of the property. Naked title, you only have the ownership, but not the use and the fruits. So what we have here, one entity has the usufruct and another entity has the naked title. Okay. Now, because of the death of that particular usufructory, napunta lang dun sa isa yung usufruct kay naked title. So, nag-merge na siya. Okay. Naked title, sa kanya yan. Usufructory, ginagamit niya yung property at kinukuha niya yung fruits out of that property. Sir, pwede ba yan? Yes, pwede yan. That is your contract of antichristus, if you still remember. So, if ever you have here your usufructory and we have here your naked title, the usufructory here died. So, the usufruct now merged into the naked title. So the question is the usufruct or the transfer of usufruct back to its naked title subject to estate tax? No, because this usufruct actually, as a general rule, is owned by the owner of the naked title. Kaso, parang binigay niya lang muna yung rights sa isang tao to use or gamitin yung property na yon or kunin ang fruits out of that property. Pero sa totoo, sa kanya yon. So may transfer ba talaga dyan? Wala naman talagang transfer. Nag-merge lang uli yung usufruct at saka ownership doon sa may-ari. Okay? Kasi yung usufructory namatay na. So it is excluded. Diba? So usufruct and naked title. Nag-merge na siya. Usufruct, namatay yung may-ari. So napunta lang uli doon sa totoong may-ari yung usufruct. So wala naman talagang transmission kasi sa kanya naman talaga yan. Okay? So yung usufruct parang pinahiram lang. Next, Section 87. Transmission or delivery of the inheritance or legacy of the fiduciary heir or legatee to the fidei commissary. Okay. Alam niyo na to. If you still remember, what should be included as a general rule is the items passing into a general power of appointment. Okay. I hope you still remember that. So only items passing into a general power of appointment should be included. But if that is passing into a special power of appointment, we should exclude it. So what do we have here? A transmission or delivery of the inheritance or legacy of the fiduciary heir or legatee to the fidei commissary. So the question here is, what is a fiduciary heir and what is a fidei commissary? Okay, so before we go there, let's have a recap on a general power of appointment, a special power of appointment. Okay, so A is the first decedent, transfers the property to B. However, under the will of A, sabi niya doon, B will transfer it to anyone. This is a general power of appointment. But if under the will of A to B, A instructs B to transfer it to a specific person. A specific person. Okay? So if that is a GPA, we said we should include it. But if that is a specific power of appointment, it is excluded. And an example of that is this transmission. So we have here A to B, and then under the rule, sabi dyan, A will transfer it to specifically one person, which is C. Si B, ang tawag sa kanya ay si fiduciary heir. Si C, ang tawag sa kanya ay si fidei commissary heir. Okay, so what is a fiduciary heir and what is a fideicommissary heir? A fiduciary heir is an heir that takes property subject to its passing to another heir. So, kukunin niya yung property, tapos ipapasa to another heir. But yung pagpapasahan niya lang dapat is fideicommissary heir. So, sino naman tong fideicommissary heir? Fideicommissary heir, this is now the second heir, whose relationship to the fiduciary heir must be 1 degree of generation. So, only 1 degree of generation. So, for example, parents ko, and then ako, anak. 1 degree yan. Ito yung grandparents ko, 1 degree, another degree. So, the transfer from your fiduciary to your fideicommissary must be 1 degree. Okay? So this is the fiduciary heir. Ako yung anak. This is the fideicommissary heir. Fiduciary and fideicommissary heir. So that is only 1 degree. So why is this excluded? Because we said it should not be included on the estate of the fiduciary heir. Why? Because in actuality, it is not owned by the fiduciary heir, but it is owned by the fideicommissary heir. So, A, namatay. Tapos, B, namatay. Isasama ba natin yung property ni B kay C? Kasi ang sabi dyan, delivery of the fiduciary heir to fideicommissary. So, ang una nating rule, sabi ni A, namatay siya, ibibigay ko yung property kay B, subject na ililipat ni B yan kay C. So, this is a specific person type of appointment. So, we call this a special power of appointment. Once it is a special power of appointment, it is exclusive. It is excluded. However, here, medyo malilito lang kayo kasi binibigyan kayo ng names. Fiduciary heir, fideicommissary heir. Pero sino ba yung mga yan? Fiduciary heir, siya yung first person who takes the property subject to the passing to the fideicommissary. Fideicommissary is the second heir in which whose relationship to the fiduciary heir is 1 degree. So normally, from parents to anak lang yan. Okay? Sir, paano naman kung from parents to the kapatid of parents? So, kapatid of parents, is that 1 degree? Okay. Pag 1 degree kasi, ang degree, kinakount siya based on the common heir. So, here, parents and kapatid. So, nanay mo, tapos tong kapatid ng parents mo, yan yung mga uncle mo or auntie mo. Okay. A-U-N-T. Okay. Uncle and auntie mo. So is your uncle and auntie considered 1 degree? So you look into their common predecessor. Their common predecessor is your grandparent. Okay? So from your grandparent, you count. You count from your grandparent. So parents to grandparent, 1 degree. Grandparent down to your uncle and auntie, that is another degree. So how many degrees? 1 or 2 degrees? It is 2 degree. 1 and 2. Kasi from grandparent, isang move. Grandparent to kapatid, which is your uncle or auntie, another move. So the two movements represents 2 degree. So each movement from a particular heir is considered 1 degree. So from parents to anak, that is considered 1 degree. Sir, how about from my uncle or auntie to to me? Okay. So ikaw naman ay pamangkin. So in a pamangkin, what is the degree? The degree is go first to the common predecessor. The common predecessor is the grandparent. So kapatid or uncle or auntie to grandparent, 1 degree. Going to grandparent to parents, 2 degree. And then parents to anak is 3rd degree. So 3 degrees yan. Ganun. So ang kailangan nandito sa transmission from fiduciary or fideicommissary, ang kailangan 1 degree. Pag hindi nag 1 degree, hindi siya pwede. Clear yan? 1 degree lang dapat yan kasi ang fideicommissary, transmission niya from your fiduciary is 1 degree. Pag hindi, edi hindi siya tawag na fideicommissary. Okay? So, A namatay, sabi niya sa will niya, i-transfer mo yan kay C, the fideicommissary heir. So si B, ang tanong, pag namatay siya, isasama niya ba yung property na matatransfer kay C? No. Kasi hindi niya naman talaga sa kanya yan. Yan ay kay C. So dapat ang may estate tax dyan is A to C. Ang may estate tax dyan is A to C. Yung B to C, hindi na. Hindi na. Okay? It is only A to C. Special power of appointment. Alam niyo naman na yan, it is excluded. We just need to know what is fiduciary and fideikommissary for us to properly understand this special power of appointment. Okay, as a rule, GPA include, SPA exclude. Example of SPA, this one, under section 87, letter B. This is 87B. We go now to section 87C, transmission from first heir, legatee, or donee in favor of another beneficiary in accordance with the will of the predecessor. Okay. So, andito na naman tayo sa will of the predecessor. Anong meron pagka may will of predecessor na transfer? So, A, namatay. B, namatay. Ngayon, magta-transfer na yung property papunta kay C. So, this C is based on the will of A na namatay. So, we call that again an special power of appointment. Special power of appointment, what is the effect? It is considered excluded. Okay. So if you are asked, what are the special power of appointments that is provided under the law? We have section 87B and section 87C. But anyway, I just want you to know the particular section. But in case, dalawa lang sila. Yung dalawang transmission, fiduciary heir to fideikommissary, and in favor of the will of the predecessor. Okay? So dalawa lang. Special power of appointments, fiduciary to fideikommissary, and in favor of the will of the predecessor. And lastly, section 87D on your section 87. Okay. So section 87D, all bequests, devices, legacies, or transfers to social welfare, cultural, and charitable institution, provided that no part of net income of said institution inure to the benefit of any individual, no part. And next, not more than 30% of such transfers shall be used for administration purposes. It must be for operational purposes and not for administration purposes. Okay, so once there is a transfer to social welfare, that should be excluded. Transfer to cultural institution, that should be excluded. Transfer to charitable institution, that should be excluded. If ever 30% of such transfer is not used for administrative purposes and no part of the net income of that institution will benefit a particular individual. Okay, so we're done with 3 exclusions so far. We have your exclusions from section 85, which we have already discussed the capital of surviving spouse. Section 86, Section 104 pertains to your non-resident alien. And then we have Section 87, which are your different transfers, merger, transmission fiduciary to fideikommissary, transmission according to the will, and transmission to your social welfare, cultural, and charitable institution. Another, we have your Section 97, withdrawals from bank. So your withdrawals from bank, if ever there is a withdrawal from a particular person to your bank of the bank of the decedent, this should be also excluded as part of your gross estate because it constitutes a final tax. But actually, I have a problem regarding this particular section because I don't know how do they treat that particular withdrawal. Okay, so generally, before, in your NIRC, a withdrawal from bank can only up to the extent of 20,000 pesos once the particular decedent died. So ano ba yung kino-constitute nito? Section 97 happens in case we have a decedent and that decedent has a bank account. So normally, you cannot withdraw out of that bank account unless guys, it is made by the decedent. Lalo na pagka passbook yan. Okay? But now, under the law, so that we can make use of the money of the decedent, the law provides that you can now withdraw up to whatever amount you want out of the bank account of the decedent, so long as it is made within 1 year from the date of death of the decedent, and the bank has knowledge of the death of the decedent. So there must be knowledge from the bank that that particular owner of the bank account is already died. So there is a bank account, the owner already died, and the bank withheld 6%. What is my problem out of these withdrawals from the bank? So we said we should exclude it from gross estate, and it is subject agad-agad 6%. So have here 600,000, let's see. That is the amount of your withdrawal. You will subject it, 6% of your final tax. So this is 36,000, right? This is your tax paid. Now, what if the dissident is considered married? What if the dissident is considered married? What is the rule? The bank account of that dissident is considered a conjugal property. So if that is a conjugal property, yes, it is included, but since it is conjugal, you only get one half, and another half is for your surviving spouse. So in short, what should be taxed must be only one half of that. But since under the rule, you must withheld directly 6% out of that withdrawal, then you paid 36,000 out of that. But it should have been only one half of it, 18,000. So you are taxed more because of this rule. I don't know what they do in actual practice because there's no revenue regulation applying to this particular section. So what is only known right now is if ever you withdraw from the bank account of the dissident, the bank should withhold 6% upon knowledge of the death of the dissident. Okay? So problem now arises if ever that particular dissident is married, you are taxed more if ever because the bank will just withhold 6% out of your withdrawal. Next, exclusions under special laws. Okay, we're done with your exclusions under NIRC or your train law, section 85, section 86, section 104, section 87, and section 97. So generally, it's easier for us to understand these exclusions because we're done discussing the inclusions. Next, we go with your exclusions under special law. First, insurance from GSIS and SSS. Okay, what did we say? As a general rule, what do we include in your insurance if ever that particular insurance is considered revocable? So all revocable insurance should be included. All revocable insurance should be included. But how about your insurance from SSS and GSIS? We said they are excluded. So ayan, excluded siya. Next, amounts received from Philippine and United States governments for war damages. This is provided under your special law that if you have war damages, if you receive something out of your war damages, you should exclude it. Amounts received from USVA, you should exclude it. Retirement benefits under RA 4917, you should exclude it. But this one actually is not considered an exclusion because under the rule, you should include it first on your gross estate and then it will form part of your deduction also. Clear? Include it first and then deduction. Next, payments from Philippines and US governments, legal heirs, World War II veterans, so long as they are considered war damages. Okay? So in short, SSS, GSIS exclude, RA 4917 include first and then place as a deduction. All war damages, so ayan you Philippine, US government war damages, US Veterans Administration, war damages uli yan, exclude, war damages uli, exclude. Okay, so again, we have the following exclusions. What are the exclusions? We have your exclusions coming from your NIRC or your train law, and your exclusions under your special law. So let's look back on your gross estate. So we have here your gross estate, properties at the time of death. We have here your general rules as to your inclusions. And then we have your additions to the gross estate. What are these additions to your gross estate? These additions to the gross estate are items of your gross estate However, we cannot really ascertain it at the time of death, but should have been or should be included at your gross estate. What are those? You have your TCOD, transfer in contemplation of death. We have your revocable transfer, your transfer under GPA, proceeds of life insurance policy, transfers for insufficient consideration, claims against insolvent person. Okay, we said this one. You should include it. And then we also place as a deduction. Heirs under RA 9417, we said we should include it and then we should deduct it. Okay? So by now, after knowing what are the inclusions and what are the exclusions, it will be easier for us to determine the gross ST. Okay? So inclusions, let's go back. General rule. We have your residents and your citizens. World, non-resident alien, Philippine only. And we have these certain additions. What are those? These items. Exclusions, we have two. Exclusions coming from your train law, and then exclusions coming from your special law. Train law, the capital of your surviving spouse or your exclusive property of surviving spouse. Next, we have your foreign property of a non-resident alien. We also have your personal property, intangibles, considered under your reciprocity. Next, we have your certain transmissions, merger of usufruct and the owner of your naked title. So who died there? It is the usufructory. Therefore, the usufructory just merged to the actual owner. So there was no actual transfer there because the owner only got, again, the right to use and the fruits out of the property. Next, we have your transmission, fiduciary, heir to your fideikommissary. Another, transmission from your legatee or from one heir to the will or in accordance to the will of your decedent. And then lastly, transfers to your cultural and charitable institutions, including social welfare institutions. And then lastly, those withdrawals from the bank, subject to your 6% withholding tax, considered as final tax. And under special laws, we have your proceeds of GSIS and SSS. We have already discussed that. We also have your war damages, and we also have your RA 4917. 4917. This was 4917. Okay? So if you have plot in your mind these items, it is easier for you to determine your gross estate. Actually, what is hard here is your exclusive property of your surviving spouse because you need to remember all the rules. So just remember the rules on your exclusive property of surviving spouse. If you are considered a married dissident, we have your conjugal property include in your gross estate. If ever you have exclusive property, determine if that exclusive property is the surviving spouse or your dissident. Surviving spouse exclude, of your dissident include. So those are your inclusions and your exclusions in your gross estate. So we're done discussing valuation, inclusions, and exclusions on your gross estate. We go now on your deductions from your gross estate. So deductions from the gross estate. So as a general rule, this deduction is considered conjugal or communal. So in case, guys, we prepare in estate tax, as we said a while back, we have here your communal or conjugal property, and we have your exclusive property. So on your communal and conjugal properties, so we have here your gross estate. We have already, once you determine the amount of your gross estate, we have your deductions. So generally, ordinary deductions is considered a deduction on your conjugal or communal properties, except if the law or rules provide it to be exclusive. Except if the law or rules provide it to be exclusive. Okay, please take note of that. It is communal except if the law tells you to be uh, it to be exclusive. So your deductions from your gross estate can either be an ordinary deduction or a special deduction. Actually, per the ruling or per the laws, train law per se, it is not classified as ordinary or special. It is only considered as deduction. So there was no mention if that is considered ordinary or special. However, based on a revenue regulation provided under the BIR, they classify your deductions as either ordinary or special deductions. So first, ordinary deductions. These deductions, as provided for by law, consist of your expenses, losses, indebtedness, taxes, and etc. We call it your elite, okay, elite deductions. But actually, it is not only your elite. We have your elite plus PPU plus your vanishing deduction. Okay, so this under the RR is considered as ordinary deduction. So elite, expenses, losses, indebtedness, taxes, and etc. plus transfer for public use plus your vanishing deduction under the RR is considered ordinary deduction. And we have also your special deductions. So these are allowable deductions that are still allowed by law aside from your ordinary deductions. So examples is your family home, your standard deduction, and the amount received by heirs under RA 4917. We also have your share of surviving spouse. We consider those items as special. To start first with your ordinary deductions. So the following are your ordinary deductions. As we said, it is considered elite plus PPU, transfer for public use, and we have your vanishing deductions or property previously taxed. So first, claims against the estate as an ordinary deduction. We talk about your claims against the estate together with unpaid mortgage and unpaid taxes because these are all claims against the estate. So, unpaid mortgage, unpaid taxes, and claims against the estate are all considered claims against the estate. So, we look as to the deductibility of this item. So, when we say claims against the estate, these are different claims or liability of the estate except mortgage, except taxes. Okay? All claims or liability of the estate except mortgage, except taxes. Okay? So this is a general clause, claims against the estate, except mortgage, except taxes. But if the liability is due to a particular mortgage, so these are your mortgage payable, then you place it under unpaid mortgage. So for unpaid mortgage, you place here the mortgage including accrued interest expense. Okay? For your unpaid mortgage, you include here your liability out of your mortgage or your mortgage payable plus any accrued interest expense out of that mortgage payable. For unpaid taxes, you only include the taxes due at the point of death. You only include taxes due at the point of death. So any tax after death is considered not a deduction. Any tax after death is not considered a deduction. Only unpaid taxes at the point of death. Again, claims against the state, unpaid mortgage, unpaid taxes, these are all liabilities of the estate. Okay. So if your gross estate is considered the assets of the estate, these claims against the estate is considered the liability of the state. However, guys, take note, you need to separate unpaid mortgage, unpaid taxes, and the other claims. Okay? Unpaid mortgage, mortgage plus accrued interest expense. Unpaid taxes, only the taxes due at the point of death. If the tax is due after death, then you should not include it. Next, we have your claims against insolvent persons. If you still remember, we have discussed this one as part of your inclusions. So we know this one as your receivables or your net receivables. So when we talk about your net receivables, aside from the fees amount, we include any accrued interest income. Okay? Because accrued interest income is considered as an addition to your gross estate. Okay. So once you include your receivables or your net receivables as item of your gross estate, and some or all of that portion is considered uh, not to be received or considered unrecoverable, if ever some portion is considered unrecoverable, then you should place it as a deduction as to the unrecoverable amount. Sir, how can we compute for our unrecoverable amount? So our net receivable, you deduct it to your recoverable amount. So for example, you have a loan receivable to a particular person amounting to 5 million pesos. However, you can only collect up to 3 million pesos. So the collection is considered the recoverable amount. The loan receivable is considered as a claim against insolvent person because you cannot collect, collect only partially or cannot collect at all. So you can only collect partial amount out of it, that is 3 million. So what is your considered deduction? Your considered deduction is the 2 million pesos. The considered deduction is 2 million pesos. Sir, how about if my loan receivable is 5 million, I cannot collect anything, then your deduction is 5 million. But the rule here, in your claims against insolvent person, add it first to your gross estate and make a deduction out of the unrecoverable amount. The unrecoverable amount is equal to your receivable or your net receivable less the amount recoverable. Claims against insolvent persons. Next, we have your losses. So for your losses, whether that is a loss out of casualty or loss out of theft or embezzlement, it should be within 1 year from the date of death. So for losses, whether that is considered a casualty loss, such as your shipwreck, such as your typhoon, so those losses, in case there are losses on your gross estate due to this. Another is if there is a loss due to theft or embezzlement, you can deduct it, but subject to the following conditions. It must occur after or within 1 year from the date of death. Sir, what is the reason of your within 1 year from the date of death? So your estate tax return is due 1 year from the date of death. Therefore, this is the date of death. This is the due date. If ever there are losses during that time, the tax authority cannot tax already that loss because it is considered loss. Therefore, if there is a loss during this period, it should be removed. That's why it is considered as a deduction. Okay? So again, losses, either casualty or from embezzlement or theft, if it occurs within 1 year from the date of death, it is considered an ordinary deduction. Okay? Next, if ever it is not compensated with insurance. Okay, so there are two requirements. First, it must occur within 1 year. Next, it must not be compensated with insurance because once it is compensated with insurance, it cannot be considered as an ordinary deduction. So for losses, the two items must be present. It must be occurring within 1 year, and it must not be compensated with insurance. If one of the items is not present, then you cannot deduct that particular loss. Next, transfer for public use. When we talk about transfer for public use, this is a transfer to the government or political subdivision of that particular government or the instrumentality of that particular government. So normally we said on your gross estate, it depends on your decedent to whom it transfer the property in case it has a will. Now, on the transfer of property, if one of the beneficiary is considered a government or an instrumentality of that government or a political subdivision of that government, then we must remove it out of our gross estate. And how do we remove it? We place it as ordinary deductions. We place it as ordinary deductions. Okay, now, kailangan mag-ingat kayo dito. So, there is a will. There is a will of a decedent. Now, you look into your transfer. If the transfer is to a social welfare charitable institution, we have the two rules. Not to a particular individual and not more than 30% for administrative purposes, so that it will be excluded. So the treatment of this transfer is excluded. Another transfer is your transfer to your government. The effect of this is it is included in gross estate, but it is considered a deduction from gross estate. Ingat kayo dyan. Kasi ito, hindi siya deduction, it is purely excluded. Ito, it is included, but considered a deduction from gross estate. Okay? So nasa world estate mo yan or Philippine estate mo yan, nakasama siya, but you will remove it because under the law, it must be considered as a deduction. Okay? Transfer for public use. Transfer to the government or to the full political subdivision of that government or an instrumentality of that government. Last, we have your vanishing deductions or property previously taxed. What is this vanishing deduction or a property previously taxed? So there is a property that is already taxed by a succession or by a donation, and then subsequently you will again tax it. Okay. So vanishing deductions. So in a vanishing deduction, as I told you, there is a previous succession or donation. Okay? And then, subsequently, there is another succession. That's why it's called property previously taxed. Okay? It's called property previously taxed because there is a previous succession or donation, and there is a new succession. Okay? What we have here is a succession because we talk about your estate tax. Okay? So there is a previous succession or donation, and then there is a debt, there will be another succession. So what we avoid here is the double taxation because from one property of debt and then another property same property again subject to a tax. So for example, A died and then transfers the property to B, and then B subsequently died. On the transfer of A to B, there is already a estate tax. B to its heirs, there will be another estate tax. But that is considered a same property. So, kung ganyan yung mangyayari, there can be a double taxation. To avoid that double taxation, we provide a vanishing deduction. But take note, there is only a vanishing deduction if the subsequent transfer is made within 5 years from the previous transfer. Okay, so A to B, namatay si B within 5 years, napunta sa heirs niya. So yung transfer kay B to H, meron ka ng vanishing deduction kasi it is within 5 years. You can only claim vanishing deduction if the subsequent transfer is within 5 years from the previous transfer. A to B namatay, si A napunta kay B. Namatay si B, napunta kay H. Yung transfer is within 5 years now from B to H. We have a vanishing deduction. So how do we compute for your vanishing deduction? First, we determine the initial value. What is that initial value? Lower of FMV. So what FMV again? FMV at the date of transfer. So we have your previous transfer and the subsequent transfer. The previous transfer is from A to B. The subsequent transfer is B to H. So you get for the same property, you get the fair market value, previous transfer, and the subsequent transfer, whichever is lower. So let's say A to B, the fair market value is 1 million. Subsequent transfer B to H, the fair market value now is 1.5 million. So the lower is 1 million pesos. Next, you get for your initial basis. Your initial basis is the lower fair market value less your paid assumed mortgage. In short, this is known as your initial value less paid assumed mortgage. Okay, so what is this paid assumed mortgage? So for example, what you inherited or what B inherited from A is a lot. And out of that lot, there is a mortgage amounting to 500,000 pesos. Okay? So, in-inherit niya yung lupa kasama nung utang dun sa lupa na 500,000 pesos. Okay? So we already determined the lower FMB, which is 1 million pesos. Now, we need to determine the paid assumed mortgage. When we say paid assumed mortgage, the amount of the assumed mortgage that is paid by the subsequent decedent. Okay. So, may inassume na mortgage si B, magkano yung binayaran ni B out of that mortgage? So, assuming the beginning mortgage is 500,000 and the mortgage ending is now only 450,000. So, how much is the paid assumed mortgage? So, if B assumed 500,000 mortgage, but the ending is only 450,000, the paid out of that assumed mortgage is 50,000. So 1 million less the 50,000, we have here 950,000 as the initial basis. Next, we compute for your final basis. To compute for your final basis, that is initial basis less your initial basis over gross estate times other ordinary deductions. So in short, you get for your initial basis, which is already 950,000, and then you need to multiply it to 950, the initial basis, over the total gross estate multiplied by your other ordinary deductions. What are your other ordinary deductions? Elite plus transfer for public use. Because we have only three ordinary deductions. Elite, expenses, losses, indebtedness, and taxes. Then we have your transfer for public use. Then we have your vanishing deduction. Since we are computing now for vanishing deduction, what do we mean by other ordinary deductions if you have only three? Therefore, that is elite and TPU. That's why to compute for your for your final basis, that is equal to your initial basis multiplied by the proportion out of your ordinary deductions, elite plus TPU. And then we can now compute for your vanishing deduction. So final basis is equal to your initial basis multiplied by initial basis over gross estate multiplied by other ordinary deductions. Other ordinary deductions talks about your elite plus TPU. Now we talk about your vanishing deduction. What is your vanishing deduction therefore? Your vanishing deduction is equal to your final basis times 3. The question is, what is the rate? Okay, the rate depends on the transmission of the subsequent decedent. If it's transmission within 1 year, 2 years, 3 years, 4 years, 5 years. Okay. So, namatay siya within 1 year, or namatay siya within 2 years, namatay siya within 3 years, namatay siya within 4 years, namatay siya within 5 years. So, ganun yung titingnan ninyo. Kasi nga, ang kwento dito sa vanishing deduction, A, either namatay or nag-donate kay B. B, namatay. So, i-count nyo yung time from the first transfer to the time of death. Is it 1 year, 2 years, 3 years, 4 years, or 5 years? So, depending on the rate, so 100% pag within 1 year lang, namatay din si B. 80% pag within 2 years lang, namatay si B. 60, 3 years, 40, 4 years, and 20% if 5 years. If more than 5 years, 0% because there is no more vanishing deduction. Take note, there is only vanishing deduction if there is a subsequent transfer within 5 years from the previous transfer. So you count from the previous transfer to your subsequent transfer, the number of years. Either 1 year, 2 years, 3 years, 4 years, 5 years. Okay? It's more than 5 years, no more vanishing deduction. How to compute? Initial value, then initial basis. Take note, paid assumed mortgage, that is the amount of the assumed mortgage that the subsequent decedent paid. Final basis, you get for your initial basis less your deduction. And then we have your vanishing deduction. Your final basis times 3. Clear? Okay. That's for vanishing deduction. So again, what are your ordinary deductions? We have 3. Elite, we have your transfer for public use, and then we have your vanishing deductions. Okay? We discussed what is already the items of your elite, or what are the items of your elite. We discussed what is a PPU and what is a vanishing deduction. We go now to your allowable deductions. So what are your allowable deductions? First, the value of the family home up to 10 million. So this is up to 10 million pesos. So for this 10 million pesos, you need to determine the value. For this 10 million pesos, you need to determine only the value applicable to the dissident. Take note, what we get here is family home. When we talk about your family home, this is composed of house and a lot. Maximum is 10 million pesos. Okay, so for example, house, lot, the value is, let's say, 4 million, and this is 10 million. Case 1, not married. Case 2, married. So, owned by. Case 2, married. So, house is conjugal, exclusive of dissident. House is conjugal, exclusive of surviving spouse. House is exclusive of dissident. Lot is conjugal. House is exclusive of surviving spouse. Lot is conjugal. Another. House is exclusive of dissident. And then lot is exclusive of surviving spouse. Or lot is exclusive of surviving spouse. House is exclusive of surviving spouse. And lot is, let's say, exclusive of dissident. Okay, so those are the different cases that we will look into as to the value of the family home. So in your value of family home, we can claim up to 10 million, but we must only get the value applicable to the dissident. So when we talk about family home, that house and lot. Okay, so case 1, not married. So if that is not married, so the total of house and lot is 14 million. Okay. So how much is your special deduction? Only up to 10 million. Therefore, you can only claim up to 10 million. Case 2. House is considered conjugal. And then lot is considered exclusive of the dissident. So since house is considered conjugal, 4 million get only 1/2 because it is conjugal. So 2 million pesos. For lot, since it is exclusive of dissident, we have 10 million. Total is 12 million versus 10 million. Lower is 10 million. Case 2, another. House is considered conjugal, while lot is considered exclusive of surviving spouse. So for house, since conjugal, 4 million, 1/2 only, 2 million. And since lot is exclusive of surviving spouse, you will not include anything. Because again, we will only include those applicable to dissident. So if it's applicable to dissident, how much then? 2 million versus 10 million, which is lower, 2 million pesos. Another case, house is the exclusive of dissident, while lot is considered conjugal. If it's exclusive to your dissident, we get the whole 4 million. And since lot is conjugal, so out of your 10 million, we get only 1/2, 5 million. So this is 9 million versus 10 million max amount, which is lower, 9 million. Next, how about if the house is exclusive of the surviving spouse and the lot is conjugal? If the house is considered exclusive of surviving spouse, only 0. Kasi kay surviving spouse yan, walang applicable kay dissident. If conjugal, magkano lang applicable? 1/2. So this is considered 5 million pesos. So 10 million times 1/2 is 5 million. So total of 5 million versus 10 million, which is lower, 5 million pesos. Okay. So take note on your family home. You need to know only the value applicable to your decedent. If ever it is single or unmarried decedent, you get the whole amount. You compare it to your 10 million. But if that is married, if exclusive decedent, 100%, exclusive surviving spouse, 0, if conjugal, 50%. Those are the rules. Okay? So value of your family home, you compare the actual value applicable to decedent, value applicable to decedent. How to compute? If that is single or unmarried, you get the whole amount. If married, exclusive of decedent, 100%. Exclusive of your surviving spouse, none. If it is conjugal, 50%. So as you can see, if we have exclusive decedent, 100% yan. So exclusive decedent, 100%. Exclusive decedent, 100%. Next, exclusive surviving spouse, 0. Exclusive surviving spouse, 0. Exclusive surviving spouse, 0. If it's conjugal, you get 50%. Conjugal, 1/2. Conjugal, 1/2. Conjugal, 1/2. Conjugal, 1/2. Those are the rules if they are married. Okay? If unmarried, 100%. 100%, 14 million, you compare it only to your 10 million cap up. You can only deduct 10 million. Clear? Value of family home. Next, standard deduction. Your standard deduction can either be 5 million pesos or 500,000. 5 million for resident citizen or residents or citizens. So resident alien, resident citizen, and we have non-resident citizen. 500,000 for non-resident alien. Next, amount received by heirs under RA 4917. So you already know that one. That can be considered as a deduction. Next, you have your share in the conjugal property. So you get for your total net conjugal property multiplied by 1/2. That is the share of surviving spouse. Total net conjugal property multiplied by 1/2 share of surviving spouse. Di ba sabi kasi natin, I'll just erase our examples in the house and lot. We said a while back that what we do is we have here your conjugal, we have your exclusive gross estate, and then we have your ordinary deductions. They are considered item of your conjugal, except if they are said to be exclusive. And then we have your net taxable estate before standard deductions. Okay. Less standard deductions. What are your standard deductions? So the first is your special deductions. First is your family home. So the amount on your family home. Standard deduction, whether that is 5 million or 500,000. And then we have your share of surviving spouse. That is 1/2 of your total conjugal property. That is your total net conjugal property. Ayan. Tapos, RA 4917, what we do here is 1/2 of the RA 4917 if married. Okay. Sir, bakit 1/2 lang? Because it is considered conjugal property. It is considered conjugal property. Therefore, since it is considered conjugal, tanggalin mo lang yung 1/2 niya. Ayan. Ayan na ha. So, conjugal, exclusive, family home, deduct mo yan. Standard deduction is either 5 million or 500,000 depending whether you are a resident or citizen or you are a non-resident alien. Share of surviving spouse, 1/2 of the net conjugal estate. So from your conjugal, gross estate, less ordinary deductions, kunin mo yung 1/2 niyan. RA 4917, only 1/2 of RA 4917 if married. But if not married, 100%. If not married, 100%. Okay? If married, one half. If not married, 100%. Let's look into your deductions as to your dissident. So for your deductions as to dissident, we have the following. We have your resident or citizen, non-resident or alien. We have already discussed, we're done discussing your ordinary deductions. What's the difference only? For resident or citizen, depending on the allowed amount. For your non-resident alien, you need to prorate it. So prorata. So you get your PH, gross estate, PH, gross estate, all over world gross estate multiplied by your total elite. So what are your total elite? Ito yan. Yan yung total elite mo. Next, transfer for public use, vanishing deductions, they are the same. They are allowed, whether resident or citizen or non-resident alien. For special allowable deductions, family home, for resident or citizen, you can deduct up to 10 million. For non-resident alien, none. Sir, bakit wala sa non-resident alien? Kasi nga, they are non-resident. Why do they have family home here in the Philippines? Diba? Why will you give a family home deduction to a non-resident? They are considered not resident here. And they are considered alien. So why will you give them family home deduction? Makes sense. Next, standard deduction. For your resident citizen, it is 5 million. While for non-resident alien, 500,000. RA 4917, allowed here in your resident, while for your non-resident alien, it is not allowed. Why? Because this is given to your employees of a private firm. And normally, these employees of a private firm must be a private firm in the Philippines. Therefore, since this is a non-resident alien, it is unlikely for them to have a RA 4917 or a retirement benefit from a Philippine company. And share of surviving spouse, they are both allowed. Okay? To take note of the rules as your deductions depending on your dissident. If the dissident is resident or citizen, or the dissident is considered non-resident alien. We go now to your taxable estate. So for your gross estate, we're done with that. Ordinary deductions, we're done with that. Special allowable deductions, we're done with that. Share of surviving spouse, we're done with that. We get now your net taxable estate. You multiply it to your tax rate, 6%, we get for your estate tax payable. So after knowing all of these items, you just multiply it to 6%, you have your estate tax payable. But again, what is the tax due date? It is due within 1 year. Okay, it is due within 1 year. So at the date of that, you must accomplish this within 1 year. So you must file your tax return. And then if ever the estate is more than 5 million pesos, you need to have a CPA certification. CPA certification regarding the inventory of your property. And if you have a foreign tax credit, so you can deduct here your tax credit. This is your foreign tax credit to get for your net estate tax payable. So how do you get for your tax credit again? Just like for your income tax, you get for your foreign net taxable estate divided by your total taxable estate multiplied by your Philippine estate tax due. Ito yung estate tax due. Para makuha mo yung tax credit. You compare which is lower. So the lower between these items. After that, you can already pay your net estate. Okay, so for estate tax, these are the items that we need to know. Gross estate, what are the items of your inclusions and what are the items of your exclusions. For these two, you need also to determine the valuation of your inclusions. For your deductions, ordinary deductions, we have your elite plus TPU plus vanishing deduction. What you need to take note only is your vanishing deduction because we have certain rules to follow here. So first, you need to determine the initial basis, which is the initial value, which is the lower fair market value. And then initial basis, that is your lower value, less your paid assumed mortgage. And then we get for your final basis, which is equal to your initial basis less the proportion of your initial basis over your gross estate multiplied by your other ordinary deductions. And then we compute for your vanishing deduction, final basis multiplied by your rate. This happens only if there is a transfer within 5 years from a previous dissident or a donation to a subsequent dissident. Then we have your special allowable deductions such as your family home, the standard deduction, whether 5 million or 500,000. And then we have your RA 4917. Share of surviving spouse, that is one half of the net conjugal estate. Net conjugal estate. And you can now determine your estate tax payable. That's it for estate taxes.